Good morning, and welcome to what I think is going to be a very fascinating ShareSoc webinar with Baillie Gifford, who are an independent investment partnership. My name is Amit Vidara, and I'm a director of ShareSoc, and I'm going to be your host for today. Today's presenter will be Ben James, who is the US Growth Trust's investment specialist.
Thanks, Amit, and thank you everyone for attending today. I hope you can all hear me, and I'm really pleased to be able to give you a deep dive and discussion on the US Growth Trust, which is run by Baillie Gifford. I'm sharing my screen, and hopefully you can all see that. We'll give it a moment to come up. But my opening question is, are you sitting comfortably? And I don't mean on your sofa at home. I mean, as if, as a human like me, you are feeling a little unsettled by what is happening in society and in the investing environment more broadly. You're not alone. Uncertainty abounds. It feels like a very uncertain time. However, as a long-term investor, and everyone talks about long-term, but I mean over the next 10 years, and if you're investing in disruptive companies, especially US growth companies, both public and private, this is actually a wonderful time. It's good to feel uncomfortable because it presents plentiful opportunities in which to find the next great winners. So in this presentation today, I'm going to cover what the US Growth Trust is, what and why we launched it, and what it offers to shareholders before going into the portfolio in detail, and then the companies and our outlook in this most amazing times to be alive. So what is the US Growth Trust? Now, we're in a period of great change, perhaps the most monumental period of change in human society. You can talk about geopolitics, you can talk macroeconomic change, yes, but it's also because we are in a new computing paradigm, an era of artificial intelligence. And it's not just on our laptops or mobile phones, it's going to be embodied in robots and vehicles. We're exploring space, far cheaper and far quicker than before. Quantum computing is becoming a real, feasible technology in the next 10 years. And this is just to name but a few paradigm shifts. And what we know at Baillie Gifford is that change, while unsettling as a human, drives growth. It drives opportunities for investments, huge long-term investment opportunities. And it's precisely this is why we launched the Baillie Gifford US Growth Trust nearly 8 years ago. So I've been working on the US growth team for over a decade now, and the team had been successfully running an open-ended fund since 1997, the Baillie Gifford American Fund, the sister fund to the trust. And it invests in 30 to 50 of the best listed growth companies in the US for the long term. And for 20 years, from 1997 on, it was, we believe, the best way to access the most exceptional growth companies in the US in stock markets. However, in the middle of the last decade, in the teens, we noticed a phenomenon in equity markets. Companies were staying private for longer than they had in previous decades before they came to public markets. And there are a number of reasons for this. And it's to do with things like the growth of capital in private markets, changes in some regulation in the US, and because businesses, through technological innovation, were able to scale much quicker than in the past. They were reaching huge sizes in terms of market cap and scale in the private markets than before. And there was, as a result, public market investors, the public stock market, didn't have all the best growth companies available to investors, especially retail investors. It had a lot, but not all of them. And so our clients were missing out on some of the most explosive transformational growth companies in their acceleration stage and the associated returns. So we launched the US Growth Trust in March 2018, a closed-ended evergreen investment company that was able to hold up to 50% of its net asset value in private companies to solve this problem for our clients. And it also enhances our public market investing. So that's why we launched. The US Growth Trust provides this access to the US's most exceptional public and private growth companies in one portfolio. Exceptional public growth companies such as DoorDash in local delivery, Cloudflare in edge computing, cybersecurity in the cloud, or Shopify in e-commerce. And on the private side, SpaceX in reusable rockets and satellite communications, Stripe in online payments, Zipline in autonomous airborne electric drone delivery. And at the end of October, the trust had over $1 billion in total assets, so nearly £900 million, and has nearly tripled its net asset value since launch. It's the only investment trust in the Association of Investment Companies North American sector that is focused solely on growth companies and that provides access to both public and private growth companies in one portfolio. And in this sense, it is unique. And it does this for retail shareholders at a low cost, 0.7% ongoing charges figure. This compares to the 1.4% average of the North American AIC sector and is miles away from the classic 2 and 20% carry most private equity funds charge investors. So it gives everyday investors access to world-changing companies in the most innovative economy in the world, the US, whether they're public or private. The role that this trust plays in people's portfolios should be one, we think, of satellite. Now, this is not advice. Now, if you want broad exposure to all the companies in the US market, this is not the investment vehicle for you. You can buy a cheap S&P 500 tracker fund that gives you this market return. That's great. But the role this portfolio plays, this fund plays in your portfolio, is to give you this early exposure to the winners of tomorrow, the winners of 2030 and 2035, before they become the largest positions in the S&P 500. So in a way, we are a hedge against a world that's changing faster than conventional risk models and benchmark construction allows. So people typically plug us on the side of their broad market exposure and let us find the next Nvidias, the next Teslas, and the next SpaceXs. So that's not advice, but that's how people typically employ us. Our investment philosophy has these 3 pillars: seek outliers, be bold, and be patient. We seek outliers because in the long run, the market data show that most companies underperform cash, the majority. Only a few outlier growth companies drive the majority of the market return. And our role is simply to identify the winners of 2030 and 2035 today so that we can capture their huge potential upside for our clients' portfolios. We need to be bold, therefore. We play this specific role in people's portfolios. We provide exposure to the best growth companies in the US, public or private, and we don't want to dilute their future returns by over-diversifying them just in the name of safety. So we run a relatively concentrated portfolio, high conviction portfolio. Over 75% of the portfolio is in the top 30 names, and it looks nothing like the S&P 500. And finally, our edge, we think at Baillie Gifford, whilst analysing structural change, is to be patient. We have to be more patient than anyone else, really, to capture the gains of these exceptional growth companies. Because a lot of the times you can look out of sync. You can look out of sync with the market. And you can spend a lot of time underperforming the market over 1, 2, or even 3 years. And we have to be comfortable with that because that volatility is always associated with outlier companies. The highest returning companies over the long run also tend to be the most volatile on average. So you need to exert a level of patience that few can match in order to capture a 10x return, a 20 times return, a 50 times return of your initial investment. One of the biggest mistakes we can make is to sell our future outliers too early. And a great example here is NVIDIA. So as a firm and in this strategy, the US growth strategy, we've been invested in NVIDIA since 2016, 2 years before we launched the trust even. And in the 10 years that we've owned it, it has fallen by more than 30% on at least 5 occasions. Indeed, in the middle of 2022, the terrible performance in the market for growth stocks, and only a few months before ChatGPT, remember, was launched, NVIDIA was down 60% from its 2020 highs. We first bought NVIDIA when it was a $43 billion plucky mid-cap. It's now $4.3 trillion. It's 100 times larger than when we first invested, or a 9,900% return. And if you'd sold because of volatility, you'd miss out on that. The team that runs the portfolio is deliberately small, but has access to vast amounts of information from Baillie Gifford's broader research. Gary Robinson and Kirsty Gibson, they're the co-managers of the trust. They're both partners at Baillie Gifford, and they have spent their entire careers here. Now, being partners in the firm means that they own Baillie Gifford. They have significant investment of their own capital in the company, and also they're heavily invested in the US Growth Trust through their personal investments and their pensions. They have huge amounts of skin in the game, and therefore they are fully aligned with the shareholders of the trust. That is alignment. They lean on the investment research of over 80 people, investment analysts and researchers and managers at Baillie Gifford, who also look at US companies. And we lean on the private companies team of over 20 to form a holistic and unique portfolio. And given that we're trying to identify the winners of tomorrow, we need to think about how the world and the system in which the companies we operate is going to change over the next decade, and which companies are going to drive this change. Therefore, we don't spend too much time analyzing what Wall Street is saying. Most of this is noise. It's too short term and it's overanalyzed. We need to know what people are saying just so that we don't follow the herd. We instead prefer to spend long periods, months at a time sometimes, in the field, on the ground, networking and connecting with both public and private companies. We have networks with academics who help us understand where technologies might lead us. We also employ inquisitive journalists who go off and write cultural articles for us about who the people running companies and so on. The point is, in order to deliver a different output over the long run, you need a different set of inputs. So in summary, the Baillie Gifford US Growth Trust crosses this divide, this, I would say, artificial divide between public and private companies, and enables you, everyday investors like you, to access our network of companies, founders, and VC funds through our public portfolio, publicly available portfolio of public and private companies. Now, critically, private companies get to choose who goes on their shareholder register. And we have built over the last 20 plus years a reputation as a supportive long-term shareholder for some very special private and public companies. But this allows us to get access to the winners of tomorrow. And that's why we are owners of the likes of SpaceX. That was built up through our investment and supportive investment in Tesla. And that in turn led to investments in Stripe. And now we've invested in a company called Anthropic, which is one of the leading large language models of the AI era. It's a chatbot called Claude and beyond. So we tend to get privileged access to founders who in turn have granted us 95% of our full allocation in funding rounds. And similarly, at initial public offering, at IPOs, we regularly get among the largest allocations in heavily oversubscribed IPOs in the global market. Now, nearly half of the public portfolio in the trust was researched or invested in when it was private. Very few other managers in this space can say that. So that's what the US Growth Trust is. why we launched it, who runs it, and the role it can potentially play in your portfolios. Obviously, not advice. But let's now dig into the detail as to our current thinking, the portfolio and the companies and our outlook. This is another way of saying patience is our edge. On the bottom of this chart is what the media and headlines tend to focus on. Back in 2015, the growth scare in China. 2017, Fed tightening cycle. Then COVID and what that's going to mean. Inflation and interest rate hikes and so on. But on top is the questions that we are asking. Back in 2015, when the market was focused on the growth scare in China, we were thinking, will the falling cost of batteries and the power of Wright's law in manufacturing, which sees a associated cost decline when manufacturing cumulatively doubles, will that deliver a new class of vehicle? And could Tesla do this profitably? And it turned out to be right. And what I'm saying is that, yes, we're focused on what the impact of tariffs and of geopolitical issues and the rise of China might mean on our portfolio. But the bigger question is, what is the impact of automated freight transport on trucking going to mean for the likes of Aurora? Or what will AI do to the internet? And which companies are set to benefit and which companies are set to struggle? And we try to separate the signal from noise and build this high conviction concentrated portfolio. The key takeaway, again, is reiterating that point about patience being our edge. But we do need to focus on the short term because of resilience. It is a very important question. Companies must survive first before they are able to thrive and become the winners of tomorrow. So we focus critically on adaptability, which is about the people who run the companies and the mindset that they have, and the resilience, the financial resilience of the companies. So let's look at that. And focusing on the public companies first. We own adaptable, ambitious, and resilient companies. In the public portfolio, 90% of the portfolio is generating income or positive free cash flow. And those companies in the public portfolio that have net, don't make money in terms of free cash flow or net income, have lots of cash. And those with less than 2% cash is smaller than 1.5% of the public portfolio. And critically, they're doing this whilst also investing at 3 times the broader market. This figure, R&D as a percentage of sales, is a great predictor for long-term returns. You have to invest in change and innovation in order to stay ahead of the competition. And if you're able to do this whilst being profitable, that is a structural advantage, particularly in challenging and uncertain times. And you can see that they're forecast to grow faster and more profitably than the rest of the market. This is a great indicator also for long-term returns. We know that the data shows over the last 40 years, companies that grow their earnings or sales in the top quintile over any rolling 5-year period, whether that's in a period of decline in the economy or growth, whether there's a Republican or a Democrat in the White House, those companies that grow the most return them highest relative to the market. So this is a great indicator. So the financial strength and reinvestment capacity of our companies let us think offensively, let us think about the upside, even when macro and headlines is quite noisy. But one of the key things right now is people were asking is about AI bubbles and valuations. So let's tackle that head on. Headline figures don't tell the whole story. Context really matters here. And on the forward metrics, we are paying similar benchmark-like multiples for a much superior multi-year growth forecast and profitability expansion. So this chart shows, there's 2 here. On the left, forecast sales growth for the next 3 years on the y-axis here, and then the weighted average price to 3-year forward sales. And you can see that the S&P 500 is about just over 6.5 times weighted average price to sales for only 12% growth. We're on just over 8% for over 20% forecast growth. And if you look at just growth companies, And the Magnificent Seven, they're actually more expensive than us in many ways, but growing less fast. And it's a more stark picture on the EBITDA profitability growth. We are actually cheaper than the Magnificent Seven on the public side, forecast to grow our profits, EBITDA, by nearly 50%. So this is a modest premium relative to history, far superior sales growth on the public side. Now, I'm not saying that there isn't heat in the market. There undoubtedly is. So active stock picking right now, we believe, is absolutely critical. You have to make the decision to reduce your exposure to companies where we think valuations have gone too far and find companies where valuations are actually underappreciated. Benchmarks cannot do that. And right now, benchmarks like the S&P 500 are unusually top heavy. Many companies that outperform the Magnificent Seven over 1, 3, and 5 years are very, very small weights in the benchmark, and they don't have an impact on portfolios. Some of our best performing stocks in the public market space aren't in the benchmark. So this is why we think selectivity in an expensive and concentrated market is critical right now. Expected returns are anchored in fundamentals, revenue compounding and margin expansion, and valuation discipline provides resilience and upside. Now, I'm not saying it's not going to be volatile over the coming months and years, but this is a strong picture from which to invest. So what have we been doing? On the public side, the key message here is that the team are generating lots and lots of ideas. We've already benefited in a way from the market catching up on our ideas on NVIDIA, which we invested in over 8 years ago. And we've been recycling some of that capital into newer ideas. There's a high bar for competition for capital here. And we've been rebalancing some exposures to AI and also finding companies which have zero exposure to AI. So Knife River is a good example of that. Oh, gone one too far, sorry. Knife River is a new position we've initiated in the last few months. It is a vertically integrated aggregates leader in America. Aggregates, rocks, quarries, materials for building roads and data centers even. The interesting thing about these companies is rock is expensive to transport, and after a certain distance, it's not cost effective to deliver it. So this delivers what we call and what we see local monopolies, which delivers huge pricing power. And we've seen in investments elsewhere in the firm and ones that we've held years ago, like Martin Marietta Materials, this enduring ability to compound earnings at 10 to 15% for decades is extremely valuable and has absolutely nothing, maybe apart from data center build out, to do with AI. That is a really interesting opportunity right now. But on the other hand, you get opportunities like Figma, which is all about the innovation and disruption that can come from AI. It is a collaborative design platform for enterprises to build websites and other tools. And AI can help reshape digital creation. The founder CEO is massively focused on execution. And again, our relationship with them as a private company helped us get a meaningful allocation in a massively oversubscribed IPO. And then some of our strongest performers over the last year, like Cloudflare, which is a edge computing, cybersecurity, AI beneficiary. We took some money out of that in the last few months and put it back into NVIDIA, which we've been trimming in 2024, in order to balance some of that potential over exuberance with actual fundamentals that are growing strongly. Cloudflare's fundamentals have been exceptional, but its multiple has expanded somewhat. So we've rebalanced it into NVIDIA, which is actually on a price to earnings basis, only slightly above its 2022 lows and well below its 5-year average. And we've been taking a little bit of money out of consumer discretionary exposure. We do have some questions over the health of the consumer in the US and more broadly. But some of the companies that we've taken that money from remain high conviction holdings like DoorDash, Affirm and Roblox. But we've taken a little bit of money out of that to fund some of these ideas. So overall, still focused on these long-term structural trends of where the world might go and the companies in the US that are driving it, whilst bringing in some management over consumer sensitivity and AI cycle balance. But where are we going to go? Well, I think things are going to get very strange quite quickly. These two charts try and bring this to life. On the left-hand side, you're seeing AI in real-world scenarios changing consumer behavior. It shows the number of rides in San Francisco by Uber in the red line, Lyft, Uber's rival, in blue, and then Waymo in the purple color. And you can see that Waymo this year overtook Lyft, the number 2 player in San Francisco, for a number of rides taken by ride hailers. And this is despite Waymo, which has no one in the car, it's an autonomous taxi, taking a bit longer, say twice as long as a Lyft, and often costing a lot more than Lyft. People really care about not having a driver in the taxi. And we're starting to see this pattern replicate itself at other cities in which Waymo is deployed. So in 10 years' time, will human drivers be weird in a taxi? There's a strong argument to suggest that that is the case. And on the right-hand side, employment in postgraduate jobs is getting quite weak. People with MBAs are struggling to find careers. Now, this might not be because of AI, but there might be something in it too. So it's something we're tracking. Companies are able to be more productive because of the tools such as AI enhancing efficiencies and productivity and improving profit margins. So the question here might be actually, will margins of the last 10 years be an indicator for future profitability of some companies, particularly those that are rapid adopters of AI? But what will this mean for employment? These are the questions we're wrestling with at the moment. And similarly, who else can play this game outside of China? This chart shows the investment by 4 companies in CapEx, mostly in AI. And it's actually out of date. By the end of this year, Meta, which owns Facebook, Instagram, and so on, Alphabet, owner of Google, Amazon Web Services, and Microsoft will invest about $400 billion in AI infrastructure, data centers, chips, etc. And for context, the UK's entire spend by all the companies in the UK is about $600 billion. These are nation state-sized enterprises. No one outside of China can compete with this. And so the question that might be asked is, does mean reversion apply to these companies? They are pulling away. No other companies can likely compete. They are deepening their competitive advantages and hoovering up economic activity because they are the only game in town. And so does mean reversion in stock prices apply to these companies? That's an open debate. So underweighting US infrastructure is effectively an active bet against the inevitability of AI disrupting the economy. Now, these are the winners in the AI infrastructure layer, along with NVIDIA. But at the application layer, we're starting to see some traction and some real-term results. But if you think back to the previous paradigm shift, the golden era of the internet, that of the internet, mobile, and cloud of the last 25 years that spawned companies like Uber, Google, social media, e-commerce, digital advertising, and so on, Airbnb. That's at the application layer. And the last paradigm connected humans at scale. And that was the revolution. Now we're connecting machines at scale. And these machines are able to do tasks that humans cannot do at a speed with which humans cannot achieve. And so they'll be able to do things that are currently impossible. And so at the application layer, over the next decade, there will be companies built of which we cannot really fathom today that will become trillion-dollar companies rapidly. And in this portfolio, the US Growth Trust, we have exposure to some of the early winners like Anthropic in the private company space. So things will get strange. Do not expect reversion to the mean necessarily. We're already seeing on the left-hand side autonomous vehicles, such as the Aurora self-driving truck, which is in this portfolio. This is a public company which we held privately. It's got two lanes on freeways in the US, delivering goods in HGVs without a person driving the truck. This is 2 lanes out of hundreds of thousands of miles, of millions of miles of trucking that's taken place every year in America. And for context, last year, the trucking market in America was worth about $900 billion. And 30% of that was spent on drivers' wages. What happens when most of trucking in 10 years' time is autonomous? It's a huge opportunity for Aurora, but great disruption for employment of drivers. We're seeing delivery drones like Zipline, the private drone company, which we invest in this company, delivering groceries at the push of a button from your mobile in 10 minutes to your back garden, but also medication in hard to reach areas of Africa. And we're seeing medical breakthroughs through the use of machine learning and advances in genomic screening combined to break through and treat previously incurable diseases. And tragically, we're seeing things like drone warfare changing the face of the nature of conflict and implications for what that might mean. But over the next 10 years, we're going to see some real challenges societally. Pervasive AI through Starlink's low Earth orbit satellites. What might that mean? Space travel, great, but also what happens when there genuinely is, in 20 years' time, a colony on Mars? Who governs that? And there are threats to democracy, which we're all aware of. So while this feels rather pessimistic, what COVID-19 taught us, at least from our perspective, is that the corporate sector, companies, both public and private, drive solutions to societal problems. And this creates huge opportunity for long-term investors. And our belief is that you should invest in these long-term companies run by future-focused, long-term management teams, often founders, who can navigate these changes. And many of these companies are private. And that's why we hold them in the US Growth Trust. And I'm just bringing to light here 3 that will change the world in the next decade. SpaceX is reducing the cost of launching a kilogram to orbit by hundreds of times. It's almost like Moore's law on steroids for the speed with which it's happening. It's got unmatched reusable launch economics, plus this vertically integrated low Earth orbit satellite network called Starlink. Starlink's recurring cash flows could fund Starship, the next generation of launch, which is fully reusable. This could open point-to-point logistics, deep space missions, and allow you to build new and impossible to build materials in space rather than on Earth. More than $1 trillion in just global telecom services opportunity alone. Anthropic, a recent investment in the private space in the trust, is transforming intelligence with safety in its culture. It's one of the few teams at the sort of frontier of foundation models with this distinctive sort of constitutional AI approach and a massive growing enterprise opportunity for its Claude coding. And it could go, well, where could it go? Huge co-pilot opportunity. 20 to 30% of coding at the likes of Google and Microsoft are now done through AI. And if Anthropic can capture the $1 trillion plus generative AI market, this is huge. And it'll lock in an ecosystem alongside OpenAI and perhaps Google Gemini and have huge leverage going forward. And then in quantum computing, Quantum is the leader here alongside, say, Google's opportunities and a company that is computer that it's running. This is a credible route here to quantum computing working using photonics and existing processes. This matches our sort of patient, capital intensive, supportive edge over others. And if they unlock this, which it looks like they are able to do, it could be a force multiplier for drug discovery, material design, and beyond. So the Baillie Gifford lens here is that these are platform level companies with huge optionality and positive skews run by mission-driven people with long horizons solving problems. And that's why we invest in them and give you shareholders access to them. And the overall portfolio is exposed to change. The important structural changes in the economy, areas such as the enterprise witnessing its digital transformation, through whether that's Anthropic in the private space, Snowflake in the public space, or in finance through Stripe, the private company, which if you've bought anything online recently, it will have been through Stripe, and so on. And I can talk about these in questions. But there's the portfolio, and about 30% of the portfolio is in private companies, including 3 or 4 of the largest private companies in the world. And to focus on them briefly before I open up to questions, it's dominated in the portfolio by the top 10. The top 5 represent about a quarter of the portfolio. The top 10, nearly 29% of the 35% exposure at the end of September. They are well run, they are big, and they have a lot of cash. And if they were public companies, they would be in the FTSE 100. So overall, the portfolio is financially resilient and delivering strong growth. It is full of public and private companies that offer dynamism and disruption. It's on the right side of change, and selectivity in this expensive and concentrated market is absolutely key. And the role we play in people's portfolios is that hedge against change. So thank you for your time, and I'll open it up to questions.
Thank you, Ben. That was really fantastic, very thought-provoking. I have no questions currently in the Q&A, but I've got a few questions that have been pre-posted. So why don't we start with quite a big one for the trust in terms of its performance and the risk it was under. And let's talk a little bit. Can you give some history on Sabah and the Sabah
Yeah.
attacks?
Yes. So for those attending the webinar and they don't know, Sabah Capital is an activist investor hedge fund based in New York. And at the turn of the year, 24 to 25, they launched a series of challenges to 7 investment trusts in the UK, of which Baillie Gifford US Growth Trust was one. And they were proposing changing the board and changing the mandate potentially. This was defeated overwhelmingly in the February extraordinary general meeting. And this was a very supportive and encouraging vote of confidence in the way that the trust is managed. Since then, they have remained a large shareholder, and they are, in fact, the trust's largest shareholder. And at the most recent AGM, they again opposed the position of the re-election of the directors. And I think the safest thing for me to do, Amit, is to give you the board's point of view. So we are the managers, and the board appoints us to manage the fund, the trust for shareholders. And Tom Burnett, the chair of the board, said that following the requisition general meeting in February and the annual results in August, the board engaged with a range of institutional shareholders for views on the strategy, with all major shareholders being offered meetings with the senior independent director, Sue Ingles, and Tom Burnett. And they were very useful, productive meetings, and they were grateful for the shareholders' feedback. Sabah Capital, which is the company's largest shareholder, rejected the offer of a meeting following the annual results. Whilst they recognised the board, Sabah's right to exercise their democratic vote, the board thought it was disappointing that Sabah, without prior notice of their intention, should use their substantial holding to attempt to vote off the whole board of directors. but then not engage in a meeting after the event. Had they succeeded, without directors, the company would have been in breach of the Companies Act and the UK listing rules and its own articles, which would have led to significant consequences for all shareholders. Again, the board is going to seek to engage with Saba to understand their position, and the board remains committed to acting in the interests of shareholders as a whole. So that's all I can really say on Saba. The board is heavily supportive of the approach of what the investment managers, Kirsty and Gary and us, are trying to do and why we launched the trust. And the long-term results since inception, we've kept pace with an exceptional performance by the S&P, far above what the S&P has delivered in its long run. And the NAV has kept pace with that. And indeed, over the last year, we're ahead in share price terms. Now, the level of volatility that we have delivered has been uncomfortable for shareholders, and we fully appreciate that. And we made some mistakes actually in 2020 and 2021, 2022. But we've reflected and engaged with shareholders on that, and we put in some measures to maintain our focus on finding the outliers of tomorrow, whilst also making sure that, or reducing the chance that that level of volatility will happen again in the future. And that's some guidelines on terms of level of profitability, the types of growth companies, and so on. And that appears to be playing out, and we appreciate the feedback here. But in terms of Saba, I would just refer investors and shareholders to look at what the board has said. At Baillie Gifford, we are focused on the long term, and our supportive structure of the partnership allows us to do that. The most important thing actually for attendees is the importance of using your vote. If you want this unique offering to maintain its mandate, the important thing to do is to vote and support the board of directors in what they're trying to do. So thank you to ShareSoc for mobilizing investors and shareholders to get out and vote. So thank you, but you must get out and vote.
Yeah, not just one time at the original EGM.
Every time.
But the second time, there were few investors turning up to vote, individual investors, and it got a little bit squeaky bum time. It was quite close. And no doubt there may be further attempts to affect the trust's operation. So I think all shareholders have to be alert to that fact. We've got a question from Paul Greenwood, recent winner of the Stan Grierson Award from ShareSoc for his volunteering work. So Paul's asked, in the context of what you were just saying, actually, how do you explain in 2022 the performance where there was a nearly 50% drop in the share price?
So thank you, Paul, and congratulations on your award. The explanation is that we made some significant mistakes. There was some macro headwinds, but there were also errors that we made internally. So there was a huge pull forward of demand for many of our holdings in 2020. Something that we obviously didn't build a portfolio for, but it was caused by the COVID lockdown. And that saw a rapid acceleration of growth in some of our online holdings, to which we were overexposed versus the benchmark. And it saw exceptional outperformance. Then on the flip side, with inflation coming quicker than many in the market forecast and in interest rates rising rapidly, high growth companies whose profits are further into the future were impacted more than companies whose profits were more predictable, because the interest rate of the US, the 10-year US interest rate number is used as the risk-free rate. And if that goes up quickly, valuations compress very quickly. And that was one of the main reasons. So there was a structural change in the economy, going from a low interest environment to a normalization, shall we say, but it was rapid. The mistake that we made was believing that many of the changes that we witnessed in COVID were stickier than turned out to be the case. We believed that e-commerce would stay relatively close to where it hit in around the pandemic, because people had unlearned these habits that they'd built up over years. What actually turned out to be was that e-commerce came back on trend. It continues to increase, but it's on the long run trend. Furthermore, the importance of longer-term profitability on volatility was essentially missed by our team, or not focused on enough. So the importance of financial resilience and long-term profitability is more important. And we had overextended the duration of the portfolio. So one of the things we've brought in since that time is a minimum requirement on the public portfolio of trailing 3-year profitability guidelines. But the other factor here is that growth companies just got whacked. There was a valuation compression, a multiple compression. There was earnings expectation down revision, which really hurt. And so some of the companies that we invested in really suffered. But the regain over the last 3 years has been driven by a majority of those companies growing leaner and more efficiently than they have done in the past. So we're confident in the long run return opportunity for this portfolio. We acknowledge the challenges that our investors have had going through it. Believe me, being heavy investors ourselves in this vehicle, we experienced it. But the structural growth drivers that we are addressing are stronger than ever. The portfolios are battle hardened. The companies in the portfolio are battle hardened from the last 3 years, and they're reinvesting at higher rates of return, are more profitable, and forecast to grow faster than the market. So that is a strong indicator of long-term growth.
I've got one here, just picking out something you just said about the interest-free risk rate and the leverage that implies. It's noticeable that in the very recent past, the awareness that people are coming to have that Meta and others are funding their capital expenditure plans with debt. Now, doesn't that increase their leverage quite significantly and potential value suppression should interest rates pop up?
Yes, it's an interesting question, and we're watching this very closely. It was quite interesting that Meta, which is, a cash generating machine, has decided to move to use debt as a tool to continue funding its growth. It's done it in quite a clever way, which is an interesting thing in itself, and we can talk about that if we want to, but it is something to monitor. I think overall the portfolio's debt exposure is low. We're actually overall net cash as a portfolio on the public side, and on the private side, I showed you that chart. A lot of cash in the portfolio, or even profitable. But it's something to monitor. In terms of interest rates, though, the general direction of change appears not to be one that would replicate what happened in 2022. Going from 0.5 or 0 to 5 is far more painful than going from 5 to 5.5, right? Furthermore, the companies in the portfolio are far more leaner and efficient because of the cuts they've made and some of the hard decisions they've had to make to cut fat and not muscle. But it's something to monitor. Comes to a bigger question about the AI capex cycle and our overexposure or underexposure to it. I would refer you to a piece I've written, which people can look at. It's called "Are We in an AI Bubble?" If you go to the Baillie Gifford website, US Perspectives, "Are We in an AI Bubble?" by Ben James. It's difficult to say. There's certainly some heat in the market here, but there's also some companies which are, if capex spending slowed down, this isn't a problem really for Meta in the long run. This isn't really a problem for Amazon Web Services in the long run. They've got cash generating machine businesses behind them. It will impact the companies that rely on their capex. So the data center build out, the companies that make the diggers, the companies that build the wires, the electric generating companies who have seen their multiples expand rapidly in the market. So that's the way we're sort of thinking about it. But yeah, it's a good question, something we're monitoring.
Okay, brilliant. That was a good question as well. There's an argument, given the number of funds that are focusing on US listed stocks, that you could increase your share that's allocated to private investments from 30% upwards. So Anthropic is, in my view, a very good pick, though I wish you got in a bit earlier. But in that vein, There's a lot of
Mhm.
opportunity out there in private markets, especially since the private equity funds are all pregnant with unloaded opportunities.
Yeah, that's a good question. So the US Growth Trust can hold up to 50% of its net asset value in private companies. So that's a big headroom. But our general feedback from shareholders is that the 25-35 range, the third, one third private, two third public, given where we invest, which is the late stage. So these are companies above $500 million in valuation, but some of them are hundreds of billions of dollars in valuation, right? We're trying to find the best growth companies, whether they're public or private. And so what we're not trying to do is to be a VC fund and get into small cap, early, speculative bets. What we're trying to do is give shareholders exposure to this structural change in the market, this rise of this growth equity, these private exceptional growth companies that are huge, that would have listed 20 years ago. I think there are other structural issues with having too many privates in your portfolio. One thing being they tend to trade at a significant discount because people believe that valuations are stale. Whereas actually, perhaps I'm countering my own argument here. Baillie Gifford has developed its valuation process to publish a NAV daily. So these valuations of private companies are revalued at least once a quarter and often more than once a quarter, depending on market movements. And so sometimes we've revalued a stock 4 or 5 times in a quarter. And we tend to be much faster getting to one of these public announcement valuation data points, say a new funding raise or round or whatever, than others in this space. And so we believe our private valuations are more up to date. But I think the general feedback is that around a third is the right position for what we're trying to do. The other point is that our public equities, most of them aren't in the market. So you won't be able to in the stock in the S&P 500. We've got an 85% difference to the S&P 500. Cloudflare is not in the S&P 500. Um, you know, Lemonade Insurance, Sweetgreen. These companies aren't in the S&P 500, and yet they're public stocks which are growing really well.
Okay, thanks for the answer for that. There's another good question. Um, this one comes from Martin Northway himself, actually. Despite recent reductions in holdings, Amazon clearly remains a Baillie Gifford favorite. It's held by 4 BG funds, and as at March 25, it was the group's largest holding at 7.9 billion. Talk us through the interplay between the house view and the trust view,
Mm.
and the autonomy of your managers in the US Growth Trust, Gary and Kirsty.
Yeah, great question. What's really nice about Baillie Gifford in many ways is there's no house view other than in the equity space, growth, long term, and being active. Right? That's the house view. Um, you can be high growth, which means you often have faster growing companies and are more concentrated, like us. Scottish Mortgage is similar to that. Or you can
Mhm.
have, more durable, broader, diversified names like Monks or Saints, which is income, right? But it's still growth. Each team is almost like a boutique investment company inside Baillie Gifford. If Gary and Kirsty want to sell Amazon to zero, they can and they will. And it doesn't matter if Scottish Mortgage has it at its largest position. You can see sometimes one strategy buying a name whilst the other is selling the name. And we like that because there are different dynamics going on in a portfolio. One could be a global portfolio, one could be a regional one. One portfolio could be a blend of high growth, durable growth, and cyclical growth, and so on. Um, Amazon, though, generally speaking, ticks a lot of boxes. It's still high growth, an enduring high growth company, exploiting and its dominance in e-commerce. We think its margin profile can be a lot higher than the market predicts. It is one of the key players in AI infrastructure in Amazon Web Services. And its culture of moving into adjacent verticals to its current business, like video, Prime Video, music, advertising, its advertising business is as big as YouTube's advertising business now. That is, and then space. I mean, and so on and so forth, right? This culture of reinvesting and focusing on the long term is really attractive, both to us as a high growth manager, but also in the more moderate growth portfolios because of what it does. But to answer the specific question, if we wanted to sell it, Gary and Kirsty wanted to reduce it, we could and we would.
That's been really, really fantastic and quite insightful. Now, I think we've run out of time, so thank you very much, Ben. I'm just going to do some wrap up. We haven't got any more questions on the screen, and I've run out of all my preloaded questions and scribbles. So thank you very much indeed. So
thank you, everyone.